Okay, so you want to own an HVAC company. You buy a few trucks, hire licensed technicians, answer the phone when someone's air conditioner dies in July, and charge thousands of dollars for a system the customer cannot comfortably live without. It sounds like the perfect local money machine. Heat waves create urgency, cold snaps create urgency. Every home, office, restaurant, hospital, school, warehouse, and data center needs controlled air. The problem is that an HVAC company does not really sell metal boxes. It sells trust, speed-licensed labor, working capital, and the promise that a complicated machine hidden inside someone else's building will keep working after your technician drives away. A furnace can be manufactured in a factory. A compressor can be delivered by a distributor. A thermostat can be bought online. But the company you own lives in the space between all of those things. The diagnosis, the quote, the installation, the warranty, the callback, the financing approval, the permit, the technician's schedule, and the customer's panic when the house is 90 degrees at midnight. That is why the business looks small from the street and dangerous from the inside. In plain language, an HVAC company is a field service operation that turns equipment, skilled labor, and local customer relationships into installed climate control systems. The raw material is not only air conditioners and furnaces, it is time. A trained technician has only so many hours in a day, a truck can only visit so many houses, and a crew can only complete so many replacements before the next emergency call arrives. The product is comfort, but the economic unit is a job. One job might be a 20-minute service call. Another might be a full system replacement. A third might be a commercial maintenance agreement for a building where downtime would cost the customer far more than the repair invoice. The owner's job is to keep enough work flowing through the company to cover payroll, trucks, insurance, advertising, software, rent, inventory, debt, callbacks, and the quiet cost of jobs that were priced too low. The first gatekeeper appears before the first invoice. You cannot simply put HVAC company on a van and start handling refrigerants. In the United States, the EPA requires Section 608 certification for technicians who maintain service, repair, or dispose of equipment that could release refrigerants. That certification is not a full business license, but without certified people, a real HVAC company cannot legally do much of the most valuable work. Then, the local rules arrive. States and cities may require contractor licenses, mechanical permits, bonding, inspections, workers' compensation coverage, liability insurance, and sometimes special registration before a company can install heating and cooling systems. On commercial projects, the barrier becomes even thicker. General contractors want financial capacity. Building owners want proof of insurance. Public projects require bonding. Hospitals, schools, laboratories, and food facilities care about downtime, safety documentation, and service history. Money alone is not enough. You need permission from regulators, credit from distributors, trust from homeowners, authorization from manufacturers, and labor from technicians who can leave for a competitor if your pay plan is weak. The entry price depends on the version of the business you are buying. At the smallest level a working owner can start with one truck, tools, licenses, insurance, basic inventory, accounting software, phones, a website, and enough cash to survive while calls become customers. That may look cheap compared with buying a hotel or building a power plant, but it is still not free. A real one-truck operation may need tens of thousands of dollars before it produces dependable profit, and the first owner often pays with personal time instead of formal payroll. A serious local company is different. 5 or 10 trucks require vehicles lifts, recovery machines, diagnostic tools, warehouse space, uniforms, dispatch software, phones, marketing managers, financing relationships, and enough working capital to buy equipment before the customer pays. If each truck needs a technician, inventory, insurance, fuel, and a stream of booked calls, the company becomes a routing puzzle with a balance sheet attached. Buying an established HVAC contractor costs even more because the buyer is paying for the customer list, brand reputation, phone number maintenance agreements, employees, service history, and local search visibility. The assets on the balance sheet may look ordinary. Trucks depreciate, tools wear out, inventory moves quickly. The real value is that when the temperature spikes, homeowners already know whom to call. That is where leverage enters the story. A lender looking at an HVAC company sees recurring need, fragmented competition, and a service people often cannot defer. A private equity buyer sees a market with thousands of small operators and imagines a roll-up buy one local company, keep its brand centralized, marketing and purchasing, add software, improve pricing, and use the cash flow to buy the next one. The logic is attractive. The Census Bureau's 2023 County Business Patterns counted roughly 111,000 employer establishments in plumbing, heating, and air conditioning contracting in the United States. Fragmented markets invite consolidation because no single local owner controls the whole map. Watsco, the large HVAC-R distributor, described the residential HVAC-R market on an installed basis as an estimated $156 billion in an April 2025 industry report it cited in its 2025 filing. That number includes the contractor's value, which is exactly the layer an HVAC company is trying to capture. But fragmentation is not an accident. It exists because local execution matters. A company in Phoenix does not have the same seasonality as a company in Minneapolis. A technician who is excellent with residential heat pumps may not be the person you send to a supermarket refrigeration emergency. A call center script cannot fix a bad installation. Centralized purchasing does not help if the wrong part is on the wrong truck. The revenue stack begins with repairs. A capacitor fails. A blower motor dies, refrigerant leaks, a heat pump freezes. The customer pays for diagnosis parts and labor. Repair work can carry attractive gross margins because the customer is paying for expertise and speed, not only for the physical part. The problem is that repair demand is chaotic. Calls cluster when the weather is extreme, and the company cannot send the same technician to 5 emergencies at once. The second layer is replacement. This is where the large tickets live. A customer with a 15-year-old system may approve a full change-out outdoor unit, indoor coil, furnace or air handler, thermostat lines, duct modifications, electrical work permits, and disposal of the old equipment. A single residential replacement can produce several $1,000s of revenue. A commercial replacement can be much larger, but the cash does not all belong to the owner. Equipment, labor, commissions, permits, subcontractors, warranty, reserve financing fees, and overhead eat into the ticket before profit appears. The third layer is maintenance. Maintenance agreements smooth the calendar. The customer pays for seasonal tune-ups. Priority service discounts, filter changes, refrigerant checks, and a relationship with the company before the system breaks. In theory, maintenance turns emergency revenue into recurring revenue. In practice, it also creates obligations. The company has to show up, schedule visits, staff shoulder seasons, and avoid overselling cheap tune-ups that become expensive truck rolls. The fourth layer is indoor air quality ductwork controls and add-ons. Filters, humidifiers, dehumidifiers, smart thermostats, duct sealing, zoning, insulation, coordination, and ventilation upgrades can raise the average ticket. Electrification and heat pump adoption add another layer because the company may now discuss electrical panels, utility rebates, tax credits, and local building codes. The IRS's 2025 guidance, for example, allowed credits for certain qualifying heat pumps and heat pump water heaters with a separate limit for those products. For the contractor that creates a sales opportunity, but also a compliance problem, a technician who explains incentives incorrectly can destroy trust, even if the installation itself works. The fifth layer is financing and referral economics. Many homeowners do not have $10,000 or $15,000 sitting in a checking account for a surprise system replacement. Consumer financing can turn a rejected quote into an approved sale. It can also add fees, paperwork, lender rules, and pressure to close. Lead platforms, big box retail, referrals, home warranty companies, property managers, builders, and commercial facility managers can send volume, but they often demand lower prices, fast response times, or revenue sharing. That is the first major lesson. Revenue is not just demand. Revenue is demand after the customer chooses you, the lender approves, the distributor has equipment, the technician is available, the permit is handled, and the system works after installation. Now look at the cost machine. The largest cost is labor. The Bureau of Labor Statistics reported that heating, air conditioning, and refrigeration mechanics and installers earned a median annual wage of $59,810 in May 2024. and it projected employment in the occupation to grow 8% from 2024 to 2034. That is good for demand and difficult for owners. A growing trade with limited skilled labor gives technicians bargaining power. If you underpay, they leave. If you overstaff, fixed payroll consumes the slow months. If you hire too quickly, training quality drops and callbacks rise. A technician is not just a wage line. Each one needs a truck insurance, fuel, tools, uniforms, mobile software, supervision, continuing training, and time that cannot be resold once wasted. The truck is a miniature warehouse. The best companies know what should be stocked on it, which parts move quickly, and which items tie up cash. The worst companies turn every missing part into another visit, another delay, and another unhappy customer. Marketing is the next machine. HVAC demand exists, but it does not automatically arrive at your phone. Search ads, local service ads, SEO, reviews, call tracking, yard signs, mailers, referral programs, and big box partnerships all compete for the same homeowner at the same emergency moment. In peak season, the winner may be whoever answers first. In slow season, the same company may pay aggressively for leads just to keep technicians busy. Insurance and compliance sit underneath everything. A technician can damage a home, miswire a system, violate a refrigerant rule, injure themselves in an attic, or misdiagnose a commercial unit that protects inventory. Workers' compensation, general liability, vehicle insurance, licensing fees, safety training, permits, and warranty reserves are not glamorous, but they decide whether revenue survives contact with reality. Equipment inventory creates another trap. A company wants enough systems available to install quickly. Distributors want to be paid. Customers often pay after the quote, after financing, or at completion. Commercial accounts may pay on terms. Between purchase and collection, the owner funds the gap. Growth can therefore consume cash even when the income statement looks profitable. This is the strange part. A good HVAC company can be profitable and still feel short of cash. The central trap is capacity under seasonality. When the weather is extreme, the phone rings faster than the company can respond. Revenue opportunity explodes, but the bottleneck is trained labor, dispatch discipline, equipment availability, and installation quality. A hot week can make the business look unbeatable. The owner sees replacement tickets over time hours and booked calendars. When the weather is mild, the same business changes shape. Trucks still need payments, insurance still renews, managers still expect salaries, software still bills monthly, debt service still arrives, advertising may have to continue so the company does not disappear from the market. The technicians who made peak season possible cannot all be fired in October and rehired in June. Operating leverage means a company has costs that do not move down as quickly as revenue. In HVAC, that leverage can be subtle. The business is not as fixed cost heavy as an airport, but it has enough fixed structure to hurt. A 10-truck company with a full call board can print cash. The same 10-truck company with weak demand, poor pricing, and too many callbacks can bleed quietly. The failure case becomes clearer when the owner tries to scale too fast. Air Pros began in Fort Lauderdale in 2017 and grew through acquisitions into a multi-state home services platform. Bankruptcy summaries based on court filings describe a company that expanded from a single vehicle and 2 employees to more than 700 employees and more than 600 service vehicles across 8 states. The idea was familiar: acquire local HVAC and home services brands, keep the local identity, centralize support functions, and build a larger platform. On paper, that sounds rational. Local brands bring trust. Centralized marketing, finance, procurement, and call centers should create efficiency. Debt and private capital can accelerate the process. If each acquired shop keeps producing cash, the platform becomes more valuable than the pieces. The hidden variable was integration. Different branches had different systems cultures, pricing habits, service standards, and local economics. A decentralized hub-and-spoke model can preserve goodwill, but it can also preserve inconsistency. When growth is financed with debt, inconsistency is not just annoying, it becomes a liquidity problem. One underperforming branch consumes management attention. Several weak branches consume cash. A bad dispatch process becomes lower revenue per truck. A weak install process becomes warranty expense. A delayed integration becomes more overhead without the promised savings. By March 16, 2025, Air Pros and affiliates filed for Chapter 11 protection in the U.S. Bankruptcy Court for the Northern District of Georgia. One public bankruptcy monitor sourced from Pacer listed Air Pros LLC with assets and liabilities both in the range of $100 million to $500 million. Another bankruptcy data summary for AFH Air Pros listed an April 2025 filing with roughly $220 million of liabilities against less than $1 million of assets for that debtor entity. A reminder that legal structures inside a roll-up can look very different from the operating brands customers see on trucks. The company pursued separate sales of business units rather than one clean enterprise sale. That is the lesson. The HVAC market may be local recurring and essential, but a roll-up does not automatically make local execution disappear. Debt can buy companies. It cannot instantly create one operating culture, one price book, one dispatch system, one training standard, and one cash discipline. The success case shows the other side of the same machine. Comfort Systems USA is not a small residential contractor. It is a national mechanical and electrical contractor serving commercial, industrial, and institutional customers. In its 2025 annual report, the company said it builds, installs, maintains, repairs, and replaces mechanical, electrical, and plumbing systems across the United States. Its mechanical segment includes HVAC, plumbing, piping, controls, off-site construction, monitoring, and fire protection. The scale is different. Comfort Systems reported $9.1 billion of 2025 revenue, $1.31 billion of operating income, and about $1.02 billion of net income. Its backlog at the end of 2025 was $11.94 billion, with much of that tied to contracted or committed installation and replacement project work. Technology customers represented 45% of its 2025 revenue, while manufacturing represented about 22%. That tells you why some HVAC-related companies become extremely valuable. They are not only waiting for homeowners to call during a heat wave, they are building mechanical systems for data centers, manufacturing plants, hospitals, education facilities, and complex commercial properties where air cooling, humidity, ventilation, and uptime are mission critical. The business is still risky. Comfort Systems explains that fixed-price projects can produce reduced profits or significant losses if the initial cost estimate is wrong or cost overruns cannot be recovered through change orders. That is the commercial contractor version of the same trap. The ticket is larger, the customer is more sophisticated, and the contract terms matter more. A project that looks profitable at bid day can become painful if labor productivity slips, materials arrive late, or change orders are disputed. Success came from scale, diversification, technical capability, and disciplined project management. The company benefits from markets where HVAC and mechanical systems are not optional comfort products. A data center needs cooling to survive. A semiconductor facility needs precise climate control. A hospital cannot treat air quality as an afterthought. In those environments, the contractor is selling reliability inside a much larger capital project. That does not make the model risk-free. It means the best operators choose the right work price risk correctly, manage labor tightly, and protect the balance sheet, so one bad job or one mild season does not decide the company's future. Now imagine a one-year owner model for a local residential and light commercial HVAC company. The figures are illustrative, not the reported results of a specific company. You own a 10-truck operation in a warm metro area. The company does $6 million of annual revenue. Replacement installations produce $3.3 million. Repairs produce $1.4 million. Maintenance agreements produce $600,000. Ductwork, indoor air quality, thermostats, and small commercial work produce $700,000. Start with the $6 million. Equipment, parts, permits, subcontractors, and direct job materials consume about $2.4 million. Technician wages, commissions, payroll taxes, benefits, and overtime take another $1.6 million. Trucks, fuel, insurance, rent, dispatch software, phones, uniforms, training, and warehouse overhead cost $700,000. Marketing and lead generation take $500,000. Office staff, managers, accounting, and general administration cost $450,000. Warranty callbacks, bad debt, and customer concessions take $150,000. Before financing and taxes, the company has about $200,000 left if those assumptions hold. If the owner also takes salary from that number, the business is not as rich as the top-line revenue suggested. With tighter pricing, better maintenance density, fewer callbacks, and stronger close rates, the same company might produce $500,000 or more of EBITDA. EBITDA means earnings before interest, taxes, depreciation, and amortization, a rough measure of operating profit before financing structure and certain accounting charges. Now change one variable. Suppose the summer is mild and replacement revenue falls 15%. Total revenue drops from $6 million to about $5.5 million. The company can reduce some equipment purchases because fewer systems are installed, but payroll trucks, insurance software, rent managers, debt, and much of the marketing machine remain. If callbacks also rise because newer technicians made mistakes during the prior busy season, the profit can disappear. A business that looked like it could produce a few $100,000 of operating cash may suddenly be close to break-even or negative. Add debt from an acquisition, and the same mild year becomes dangerous. The lender does not care that the weather was pleasant. Principal and interest are due. If the company used a line of credit to buy equipment and cover payroll during slower months, borrowing capacity becomes the oxygen supply. Vendors may tighten terms. Marketing may get cut at exactly the moment the company needs future calls. Technicians may leave because overtime disappeared. The next heat wave then arrives, but the company has fewer trained people to capture it. That is why HVAC owners obsess over dispatch boards, average ticket size, maintenance memberships, reviews, close rates, technician utilization, gross margin by job type, and callback percentages. Those are not small operational details. They are the gauges on the machine. Bargaining power comes from several directions. Technicians have power because customers cannot be served without them. Distributors have power because contractors need equipment quickly, especially in peak season. Manufacturers have power through dealer programs, warranties, availability, and brand perception. Lead platforms have power when the contractor relies too heavily on purchased calls. Customers have power through reviews, financing approvals, price comparisons, and the ability to defer work when the weather is mild. A big box referral relationship can fill the calendar, but it may also make the contractor dependent on someone else's customer funnel. A home warranty company can send volume, but often at lower margins and with more administrative friction. A property manager can offer recurring work, yet demand fast response and negotiated pricing. Volume is useful only if the margin and cash cycle survive. The future of HVAC makes the business more important and more complicated. Heat pumps, building electrification, new refrigerants, energy efficiency standards, smart controls, grid constraints, and indoor air quality concerns are changing what technicians must know. The Department of Energy has emphasized HVAC, water heating, refrigeration, and heat pump technologies as areas where innovation can reduce energy use and operating costs. For contractors, that creates a bigger opportunity: more retrofits, more complex systems, more advisory, selling more maintenance, and more reasons for customers to replace old equipment. It also raises the skill requirement. A company that only knows old equipment may lose share. A company that sells new technology without understanding building envelopes, electrical capacity, cold climate performance, duct design controls, and customer expectations may create its own future warranty problem. Software is another structural change. Dispatch platforms price books, call recording, financing integrations, route optimization, customer messaging, and technician scorecards are making the best operators more data-driven. ServiceTitan, one major software provider for trades businesses, reported $961 million of revenue for its fiscal year ended January 31, 2026. That figure is not HVAC contractor revenue, but it shows how large the operating layer around field service businesses has become. The modern HVAC company is increasingly a software-enabled logistics company wrapped around a skilled trade. None of this means an HVAC company is automatically a good or bad investment. The numbers change with city climate, labor market, customer mix, financing, regulation, management, quality, and timing. This is an explanation of the business machine, not personal, financial, legal, tax, accounting, or investment advice. The ownership fantasy was simple: buy trucks, hire technicians, answer emergency calls, and collect money from people who need cold air or heat. The reality is more precise. You are buying a weather-sensitive labor system with licenses, warranties, inventory, credit lines, customer trust, and a dispatch board that can make or break the year. A small HVAC company can look like a local service business. A large one can become a national mechanical contractor tied to data centers, factories, hospitals, and the future of building electrification. Between those two versions sits the trap. Demand can be huge, but capacity is scarce. Tickets can be large, but cash can vanish. Growth can be exciting, but integration can destroy what the acquisitions were supposed to create. You thought you were buying air conditioners. What you were really buying was a high-pressure machine that turns heat cold, skilled labor, and customer urgency into cash if the machine itself does not overheat first.